Overleveraged. Some years ago, Procter & Gamble blindly entered into a series of leveraged derivative trades and discovered to their great surprise that leverage not only magnifies gains but, more importantly, it also magnifies losses, in their case to the tune of $300 million. This incident brought to life the risks of leverage to the corporate crowd. But retail traders are still all 100 often unaware of the inherent risks. Leverage, or gearing, is a double-edged sword that should be used sparingly, something not helped by the fact that retail FX brokers constantly extol the virtues of 200-to-1 leverage. By making it seem that with $1,000 you can control $200 is a good thing, they suck naive traders into the leverage trap, since constantly over-leveraging your trades is the equivalent of always driving at 100 miles per hour. Sooner or later you are going to crash and burn. Taking the $1,000 starting balance. If you were to trade $200 in USD, the mere 10-point move, a 0.1% move against you, would translate into 20% of your account equity getting wiped out. In fact, just by entering the trade spread you would already be down 6% on the trade, which is much more than any permissible loss. Trading position sizes this big in relation to your account size means that you are essentially trading yourself into a corner, and any market noise is bound to wipe out your account. The brokers love this, of course, since it means easy money for them. If you are over-leveraging your trades, then you may as well be handing over your cash to your broker. Professional money managers generally use no more than 2 to live times leverage. And the retail investors should definitely not use more than 10. To put it in perspective, using 10 times leverage on a $1,000 account means that the price would have to move 1,000 points against you before your account is wiped out. That is a lot of room to maneuver. And it gives the trader greater flexibility. Flexibility. Choosing the right amount of leverage is the first critical step in maintaining your flexibility in the market, which is critical if you are to survive for the long haul. Flexibility in trading means giving yourself options to enter the trade, to stay in it, and to exit. By becoming overexposed to any one position, you essentially remove options from your table until you are faced with an all-or-nothing trade, and in the FX world your survival is measured in days, not years. Since the currency markets are not one-way streets, the normal gyrations of the market mean that, given time, you will usually have an opportunity to get out of a bad trade or enter a position that you may have missed. Most traders have had the frustrating experience of getting stopped out. Only 10 CIT market relearn back flexibility. Choosing the right amount of leverage is the first critical step in maintaining your flexibility in the market, which is critical if you are to survive for the long haul. Flexibility in trading means giving yourself options to enter the trade, to stay in it, and to exit. By becoming overexposed to any one position, you essentially remove options from your table until you are faced with an all-or-nothing trade, and in the FX world your survival is measured in days, not years. Since the currency markets are not one-way streets, the normal gyrations of the market mean that, given time, you will usually have an opportunity to get out of a bad trade or a position that you may have missed. Most traders have had the frustrating experience of getting slopped out. Only 10 CIT market relearn back to your entry at some point later in the day. The only way to get around these sometimes arbitrary market movements is to stay flexible and trade multiple lots. By trading only one lot you are essentially making a 50/50 bet that the rate will move in your direction. Besides not being very wise, it has a negative expected outcome when you take the spread into consideration. It is also not much fun. You should try to think of your initial entry as your toe testing the temperature of the water in the pool. If you find body is too cold, then you can sit it out. But if it is just the right temperature, then you are free to jump right in. Trading small until you think you have all of the information and confirmation you need gives you the flexibility to properly position yourself for the move, or pull out with a small loss if your analysis is proved incorrect. As you may well know, for some reason the FX gods see fit to test our melee every time we enter a trade by moving the market immediately against us. But trading multiple lots means that our first entry does not become critical and we give ourselves a cushion while the market decides where it wants us to go. Trading in this way also means missing out on far fewer trades when compared to the all-in approach, since pulling the initial trigger becomes rather painless and makes the decision-making process much less stressful. To properly trade multiple lots you must first calculate the total amount you are willing to risk before you enter your trade. Again, different traders take different risks, but it is safe to say that the intraday trader should not risk more than 1 to 2% of their account size on any one position. This means that for $11,10,000 account, your loss should never be greater than $200 over $1 all lots combined /. Look back on your trading and see how big your losses typically are. If you are an intraday trader and every time you lose you end up taking a 3-5% hit, then you need to stop immediately and come up with better money management rules. This is the same type of analysis that professionals regularly run on their trading, and it proves very insightful since the reasons for your underperformance will most often be glaring. TradingWIDH proper money management rules will not guarantee you success, but it will prevent you from falling into the money trap. The more I bet, the more I will gain mentality is not for traders but for gamblers, and using their logic is a sure road to ruin. Avoiding this trap simply means learning to manage your losses by using simple guidelines. Never risk more than 2% on any one position. Never trade more than 5 times leverage on any one position. Trade multiple lots with multiple entries. If you cannot afford multiple 100,000 lots, trade mini lots.